Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Nouriel Roubini of Roubini Macro Associates looking ahead to the new year and writing this. Some of Trump's policies will increase growth and reduce inflation, while others could be stagflationary. So the impact on growth, inflation and on markets depends on how much of the former versus the latter. Nouriel joins us now for more. Nouriel, wonderful to see you, sir.
Great seeing you.
How difficult does it make it to look ahead to next year with any real clarity, to come up with some kind of outlook when things are so difficult?
There's a lot of policy uncertainty. As I pointed out, some of the economic policies of Trump may increase over time growth, reduce inflation, being overall pro-business, keeping tax rates on capital and labor low, deregulating the economy, and things like increasing the production of fossil fuels and pushing down the prices of energy. Probably also this Dodge initiative over time may increase economic efficiency and so on. So those are the positives. And over time, they could increase growth, they could reduce inflation. But we know there are some sets of other policy. We don't know how much they're going to be implemented. They will increase inflation and potentially be stagflationary. In my view, tariffs are inflationary. Protection is the risk of an economic war with China. First, draconian restriction to migration, if not a mass deportation. If we have unfunded fiscal deficits and the promises imply $8 trillion of deficits additional over the next 10 years, that's going to crowd out growth by increasing interest rates, nominal and real, and the bond market vigilantes are going to wake up. If you try to disorderly weaken the dollar, that could be inflationary, and if you interfere with the independence of the Fed. Now, I think on the positive side, I think there are a number of factors that are going to constrain the bad policies. One is market discipline. If you follow policy inflationary, then bond market vigilantes are going to wake up, bond yields are going to go higher, the stock market is going to correct, and he cares about the bond market, he cares about the stock market. Secondly, Fed independence. If he follows policies that lead to inflation, the Fed may not continue to cut rates next year, may even raise rates if inflation were to be going higher. And also policy choices. As you pointed out, on one side you have people like Scott Bessent who want to de-escalate on tariffs, and others who are total trade hawks on trade and on China, like Peter Navarro. So it depends on the balance between who's going to be in power.
Let's unpack some of that and pick out tariffs. Big debate already so far this morning. You've heard some of it. Please weigh in. If it's targeted, could it be a good thing for the American economy?
Well, if it's targeted, I would say that the impacts on inflation are going to be modest, and maybe some of the reshoring that already is occurring is going to continue. And there'll be actually pressure on our trade partners to say, if you don't want tariffs, you have to bring more investment, semiconductors, autos, EVs, you name it, to the United States. So that's the escalate in order to de-escalate. But I would say the higher those tariffs become, the more there's an impact on import prices, the more there's an impact on inflation, and the more there is global fragmentation. There's also the risk, of course, of trade wars, of our trade partner retaliating against the United States. If that occurs, the impact on growth is going to be more negative, the impact on inflation is going to be higher. Depends on the size of these tariffs. If it's Navarro types of policies on trade, is stagflationary. If it's escalate, de-escalate, maybe the impact on inflation is modest and the negative impact on growth is also modest.
So some people are arguing that we're in this wave of deglobalization that basically reverses some of the disinflationary forces of the 3 decades following really the mid-'80s. I'm wondering whether that's actually true, whether that's what we're seeing, because there still is quite a bit of trade. It's just going different routes. And frankly, you could see that overproduction from places like China are going to lower prices in certain places, even if they don't in the U.S. if their wall's up. In other words, are we overestimating the inflationary impact on a dramatic level of a lot of these tariffs?
Well, the impact of high tariffs on the United States would be inflationary, but if you think about the impact on growth and inflation in the rest of the world, will be disinflationary. Because if there is a shock to the demand for the exports of Europe, Asia, China, then there'll be excess supply. Growth is weakened in those parts of the world, and that leads to disinflation in the rest of the world. So the impact on the US of high tariff is inflationary. The impact on the rest of the world is disinflationary. because of excess supply.
You used to be called Dr. Doom. Are you retiring that mantle?
I always said I'm not Dr. Doom, I'm Dr. Realist. There are plenty of upside in economic growth. And by the way, some of them I think are more secular. I think the impact of technological innovation implied that potential growth in the US by the end of the decade could be close to 3%. And the fact we already have seen for the last couple of years growth of 2.5 to 2.8% with inflation falling is a sign that maybe productivity growth is increasing and potential is increasing, and we can grow faster with having lower inflation. So I'm not Dr. Doom.
Well, when it comes to tariffs, just to go back to this idea of the personnel, we know what Jamieson Greer as well thinks about China. In a hearing to Congress, he had talked about strategic decoupling. Do you expect that over the next 4 years between Beijing and Washington?
Yes, I do. I think that one of the biggest risks is not just tariff in general, but a broader economic war against China. If you listen to the long list of complaints of the Trump administration, they say China's been free riding on international trading system, tariff, non-tarifary barriers, government procurement policies, FDI policies, intellectual property rights, and of course fentanyl and lots of other things. And also geopolitically, there may be an attempt to try to contain the rise of China. So the biggest risk is not just tariff on China, but how much the overall policy toward China is going to be confrontational. And if they feel that we're trying to contain the rise, they could become quite aggressive themselves.
Well, front page of the FT today is talking about these 4 government-backed authorities that are telling local chip companies that you can no longer buy silicone from the United States. They're no longer safe or reliable. Are we already in this moment you're describing?
Well, certainly in anything to do with high tech, we've started already in the Biden administration to be in a process of decoupling, restriction to exports both of semiconductor and semiconductor equipment, restriction to anything that's related with AI and high technology. Under Biden was a narrow yard and high fences and stuff that was supposed to be critical. So de-risking, I think that in the case of Trump administration, we may move from de-risking with China to decoupling with China. There's something much more severe.
Does Europe need to pick a side?
They'll be in a very, very tough position because geopolitically, Europeans are close to the United States, NATO, and so on, but they do a lot of trade and investment with China. Under the Biden administration was easier because there was a compromise within the G7 about de-risking as opposed to decoupling. If the US goes towards decoupling and says Europeans have to follow us, otherwise there are consequences, not just on trade, but also on NATO, security, and you name it, then I think Europe is already weak, will be in a tougher spot.
How much worse could things get for the Europeans? We've been saying through this morning that France is ungovernable at the moment, which means it can't deliver reforms. And in Europe, things have to get worse before ultimately they find solutions. How much worse does it need to get?
Well, things are really pretty bad already in Europe. I think that potential growth is below 1% in Europe. Europe is going to be in the Eurozone less than 1% next year. And structural reform are not going to occur anytime soon. There's a fragmentation between these 27 countries. Some of them want more integration, some of them want less. At the core of Europe, Germany and France are going to be politically unstable. So I don't see either the Letta report or the Draghi report for more integration, for a common market, for more productivity and competitiveness being implemented. So it looks pretty dark for Europe right now.
Which is the reason why I'm surprised that so many people come in and they say it's priced in. We don't really see a path out of here. We don't necessarily see an economic engine or the political will or capability to really counter it. At what point are we facing off with a potential dollar shock? And I ask this because, yes, the euro is likely to stay around here or weaken further, but what if it actually weakens dramatically as the ECB is forced to cut rates and that divergence widens?
Well, there are many good reasons why the dollar may continue to strengthen. One is, of course, tariff. If they reduce the trade deficit, it's going to strengthen. 2, Trump had said, I want to have actually the dollar at the center of the global reserve system, and therefore that implies you want strong dollar than a weaker dollar. Relative growth differential, relative monetary policies, the fact that the U.S. is innovating and capital is flowing into the U.S. capital markets and the stock market all imply that the dollar over time should become stronger, the euro and other currencies should become weaker. The problem, however, is that Trump says a strong dollar has led to deindustrialization, to American carnage, people free riding on us, to having large trade deficit, and we want at some point a weaker dollar. The fundamentals imply a stronger dollar, but policy, there may be an attempt eventually, maybe in the second half of the administration, to find an agreement on currency, maybe to say either you accept 10% tariffs or you accept a 10% depreciation of the dollar. I would not rule out there'll be some big Mar-a-Lago agreement. These FX agreements are always in a resort. Bretton Woods,
a Mar-a-Lago Accord,
Plaza, Louvre, and so on. So a Mar-a-Lago Accord is something that they're going to think about. Not in the first 2 years, but down the line, they're going to say to the trading partners, you don't want tariffs, you have to do other things for us.
We'll pick up on that story.
Might be currency.
Let's talk about Bitcoin. Bitcoin pushing 103K, up on a session by more than 5%. Nouriel Roubini is back with us. Nouriel, you've had a big move in Bitcoin over the last month or so. Had a big move over the last several years. Have you rethought the way you think about what's happening here?
Not really. I mean, people talk about Bitcoin being a cryptocurrency like the other ones, but they're not really currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. They're not a single numeraire. Bitcoin in the past went to 70 and down, then to 16. Now it's above 100. You could have another 50% correction. So it's a speculative asset like meme stocks, SPACs, and others, highly volatile. Many people are going to it, but take El Salvador. They force everybody to use Bitcoin as legal tender, and less than 1% of all transactions are occurring in Bitcoin. So I don't think it's going to ever become a currency, but it's going to be a speculative asset.
One thing the dollar is depreciated against is Bitcoin. And I think this is where I would see some separation between what's happening with meme coins and meme stocks and what is happening with Bitcoin. There seems to be a preference. There are market participants who believe that this is a place to be if you're worried about the depreciation of the US dollar and a fiscal trajectory of the United States of America. Do you see a case for it there?
Not really, because actually when the Fed was essentially rising rates and inflation was higher, Bitcoin was falling, like in 22, as there was the stock market correction, and now the stocks are going higher, and the Fed is easing, and inflation has fallen, Bitcoin is going higher again. So historically, it's not been a hedge against inflation. Actually, it looks like it's highly correlated positively with stocks, a beta relative to the equity market. So it's not a traditional hedge like gold that is in periods of time of inflation rising or debasement or worries about the dollarization. So it's something, to me, it looks like speculative asset is highly correlated with equity. So it's not a hedge against inflation.
You say sort of parallel tracks to meme stocks and some of the other euphoria that we've seen. At the same time, there seems to be something more concrete behind this. You mentioned gold, and we are seeing that rally in gold in tandem because of what John is talking about, that store of value outside of the U.S. dollar to protect against some sort of loss of fiscal dominance. Do you see, with a more institutionalized structure endorsed by a presidential administration, there being a case for at least a crypto-based store of value that could offset some of the risks of volatility in the dollar and the potential loss on the margins of fiscal dominance down the road?
I'm not sure, because if you're worried about inflation, debasement of fiat currency, or even the dollarization, there are plenty of other assets that provide a good hedge. Short-term treasuries, tapes, oil, ag commodities, gold, precious metals. So it's not as if there is not other alternatives. And as I pointed out, in the last few years, when inflation was higher, actually Bitcoin was falling, and when inflation has fallen, Bitcoin is going higher. So it doesn't look like it's been actually negatively correlated with inflation. So it is a speculative asset. For some people, it is a store of value. But if you want to hedge yourself against inflation, I think there's a spectrum of variety of other assets that are backed actually by real income or something, store of value, that are a better hedge against some of the risks that people worry about.
But given the change of tone in Washington, do you think there could be retail adoption at any point?
Yeah, and there's already been retail adoption, but my worry is actually that the regulation on crypto might become looser like they were before, and then you have another speculative run, you have another sets of scams like FTX, SPF, and so on, and then you get another bust. So the risk is we're going to go towards very little regulation. We know there are lots of players in this space that are quite shady, and the lack of regulation actually leads to a bigger bubble and a bigger bust down the line.
Known you a long time. Just want to finish up with something positive. Looking out to 2025. Favorite region right now? Favorite economy? The place you're most optimistic about for next year? Which one?
It's a bit consensus, but I think the United States still is going to outperform, both in terms of economic growth and equity markets, yes.
It seems to be the one place to be. Hear it repeatedly, don't we? The United States, it keeps coming back to America.
It feels like TINA. This is the TINA trade. There is no alternative at a time where essentially growth is concentrated in the world's biggest economy, and maybe it's trickling out, maybe it's not, but nonetheless, you also have yield here.
Nouriel, it's good to see you, sir.
Great.
Thanks for catching up with us. Thank you. Nouriel Roubini there of Roubini Macro Associates. Let's keep it on the administration. Let's stick with politics. President-elect Donald Trump rounding out his economic team, naming former Congressman Billy Long to lead the IRS, former Georgia Senator Kelly Loeffler for Small Business Administrator, and former SEC Commissioner Paul Atkins for the role of Chairman of the Commission. Joining us now is Tobin Marcus of Wolfe Research. Tobin, welcome to the programme. A lot of focus on the Atkins appointment. A lot of focus because Bitcoin is rallying so hard. When we hear things like they are a crypto advocate, they are pro-crypto, Tobin, in practice, what does that actually mean for policy?
Well, the big complaint about the SEC from a digital asset perspective over the course of the past few years was the so-called regulation by enforcement approach that Gensler took. I think that's frankly more of an issue for a lot of these sort of smaller and newer entrant digital assets in terms of like not being able to get the clarity from the SEC that they wanted, either by trying to go through formal channels or through sort of seeking forgiveness, not permission. From a Bitcoin perspective, I mean, obviously it's been able to thrive despite Gensler's approach to the SEC and has continued to rip higher. So, I think that's obviously a kind of an animal spirit story.
So what kind of U-turns can we see at the SEC under Atkins that were put in place by Gensler?
I think Atkins is going to be broadly deregulatory across pretty much every axis. I mean, he's talked about rolling back formal rules. He's also been critical of penalties imposed by the SEC in the past. So I think even where there are enforcement actions, he's going to be tending to take a more lenient approach with an eye towards not kind of reducing competition, not imposing costs that ultimately flow through to shareholders. You know, a lot of the formal rules that Gensler put forward that have faced the most criticism are already in litigation in terms of climate disclosures, for example. You know, there's already litigation against the market structure rules that they put out earlier this fall. So I don't know how much of it is going to be a story of formally rolling back rules as opposed to just sending a very clear message that, we're not going to try and regulate through enforcement. You don't need to sort of worry about what we're going to do quite as much.
We also know who's going to be filling in now, taking the job of Jonathan Cantor over at the DOJ when it comes to antitrust, and that's Gail Slater. What can we glean into what she has said in the past about big tech companies, into maybe how Trump 2.0 might potentially be a continuation of what the Biden administration was already doing?
Yeah, that was a very interesting pick. I think a little bit more populist at the margin than we expected heading into the election, where we did think we were going to get a fairly traditional pro-business Republican approach at DOJ and FTC from a competition policy perspective. I think the clearest signal about what she stands for is what Trump said about her announcement and what we can glean from her working for Vance, both of which are really focused on big tech in terms of what's in the crosshairs. I don't see as much risk in sectors that are not kind of explicitly targeted, as we saw under Khan and Cantor in the Biden administration. But her personal trajectory, I mean, she spent 10 years as a staff attorney at the FTC. She's done some work for the tech industry. So, looking at her resume, you wouldn't necessarily think that she's going to be pitchfork wielding. But I do think the expectation, based on what Trump and Vance are saying, is that we'll see some populism in that approach.
So far, Tobin, populism aside, a lot of businesses are looking at the agenda and saying this gives us a lot more confidence going forward in our business models. There were a couple of surveys done by different places, one of them showing that now 2/3 of business executives surveyed are optimistic about the path ahead versus 26% of respondents in August. Do you think that that is justified simply because of the deregulation? And do you think that was sort of, a commentary on the regulatory regime before?
Yeah, it's fairly typical to see very dramatic reversals in business sentiment on transitions. Generally Republican leadership tends to be better welcomed, especially, some of those surveys like NFIB have a very, very strong partisan valence to them. So, I think that's not terribly surprising. I think the sentiment swings tend to be bigger than the activity swings in terms of what people are doing versus what they're saying. But, I think in both cases, we're seeing stronger animal spirits. But, our expectation heading into the Trump administration, or heading into the possibility of a Trump win, was always that the good news would be kind of front-loaded on some of those priorities like deregulation that were very clear. And then the more potentially adverse news is backloaded in terms of what happens with tariffs, what happens with some of these offsets for a fiscal package next year, where we're going to need to wait to see where these risks land.
Backloaded at the same time that people are talking about how this is really going to be first-order priority for President-elect Trump when he takes office to put tariffs on. And I wonder how much you expect that to really impact sentiment. We've been talking to a number of people about how much investors are really aware of that, the idea of tariffs coming in and not just being a negotiating tool. What's your take on that? How much are the people you speak to taking it truly seriously?
So I certainly don't think tariffs are priced in from a market perspective. I think that's the clearest thing. Even people who are taking it seriously, I think it's very challenging to figure out, what are some of these single name trades, given how much discretion the president has in implementing tariffs and how much uncertainty there is about exactly what his agenda looks like. So, there's a lot of sort of interest in it. We're having tons of conversations with institutional investors about what that might look like. But ultimately, there is a lot of uncertainty, and I think people are going to need to see it to fully believe it.
Hey, Tobin, good to hear from you. Tobin Marcus there of Wolfe Research on the outlook for policy. Markets very focused on one thing tomorrow morning, and that's the payrolls report, with the hospitality sector coming into focus. Bloomberg Economics writing the following: as this sector has been the biggest drag on headline payrolls in past Novembers, we think underperformance here will be a major factor in a disappointing headline print. A man who has to manage the hospitality sector is Eric Resnick, the CEO of KSL Capital Partners, which invests in travel and leisure. He joins us now for more. Eric, good morning. It's good to see you.
Good morning, John. Great to see you all today.
How are things going? You manage in a hospitality sector. What does the labour market look like at the moment?
Well, if you step back, we're the largest private investor in travel, solely focused on travel. We believe in the world. We have about 25 billion assets under management. 2/3 of that's in equity, 1/3 in credit, and we employ about 50,000 people. So when we look at that, I realized that in October there was comments on the softness in leisure hiring. We don't really see that. So it's there's been, I think, a resurgence of consumer confidence post-election when you alleviate the uncertainty around the presidential election. And so we're seeing bookings strong when we look into 2025. So I anticipate that whether the November jobs report is strong or not, I suspect that you'll see increased hiring as we look out over the next few months.
Before we continue, you mentioned the sort of uncertainty around the election and that affects travel. Can you explain why? Because none of us can figure that out. We've been trying to understand this, is that there's an election coming up, so I'd better just stay home.
I was hoping you could tell me. It's an odd thing, but we see it most. This is not specific to this election. Often in presidential elections, right, ad spending goes up, and generally consumers become a little less confident. I think it's just the basics of uncertainty is unnerving. Unnerving is less confidence. Less confidence, you don't spend as much, and travel's a place. In that circumstance, you tend to delay a little bit. So we saw a little bit of a softer third quarter and fourth quarter bookings going into the election. We've seen it rebound since. And when we look to 25, bookings are up. For us, advanced bookings are up about 15%. So we're very excited about that. But it is odd to me. I can't give you an answer. I wish I knew.
So when you talk about hiring, and I do want to stick on that because that's one of the key components of people's confidence and their ability to keep going and traveling, how much easier is it to hire people now? I remember a time post-pandemic where it was incredibly difficult and you couldn't find people. And in order to find somebody, you had to find someone who didn't work very hard and pay them $30 an hour after paying them $15 an hour. How different is it now?
It's very different. I would say, zooming back, what was $15 an hour, like you mentioned, is probably more like 20. In big cities, it's more. But if you look across the industry, I would say it's gone 15 to 20 over 4 or 5 years. So that's still meaningful wage inflation. That has helped. So right now, we are staffed well above levels that we're typically staffed at this time of year in terms of the pace of hiring for us going into the winter ski season. So we are basically 95% hired across Alterra Mountain Company and the Icon Pass, which is our ski pass that we created about 7 years ago.
He's catering to me. Go on.
Right, looking straight to you.
Yeah.
Over that time period, we've seen a dramatic ramp up in demand for skiing, and hiring this year has gone easier than it has probably any time since pre-pandemic.
Which raises this question about how sustainable this is going forward. And I don't want to get gloomy because this is all very positive and vacation plans are something that we all want to make. But I am curious about whether you're sort of getting to this place where what we hear from companies is that consumers are pushing back against price increases.
I think that's true.
They don't want to pay that much more. hiring is pretty easy. People are plentiful in terms of availability, not demanding that much more. Does this speak to a moment that in the past, over your decades in this industry, have been tipping points where things start to not be quite as good?
I think that the rate of growth, which was robust coming out of COVID, has now stabilized to a more normal rate of growth. There's no doubt about that. I think we also see that the more luxury end of the market is growing faster than the lower end of the market. This past year, you've seen 3 or 4% RevPAR growth in the luxury end of the market. You've seen a couple percent RevPAR decline in the economy end of the market. I think that speaks of a bit of what you're going after. There is some pricing fatigue out there. I think the consumer's willing to pay at all ends of the market. They're willing to pay for service, but you have to execute against that. If you don't execute against it, you're going to be a net loser in that industry in terms of market share. So for us, we try to be an employer of choice that helps us on gaining effectively market share of the labor market, and we try to be I'll try to also provide choice to the consumer, value to the consumer in terms of high-end service, so that they feel like while they're paying more for their vacation, they're getting more as a result. And so if we get that equation right, I don't think there's any inflection point that we're at now that's negative. I think we're in a 60-year cyclical trend of people spending more towards experiences over material goods.
When it comes to employment, though, how are you thinking about potential change of policies and the crackdown of illegal immigration by the incoming Trump administration and what that could mean for the supply right now in the market?
Look, it's a relevant issue. Again, for us in our industry, legal immigration policies are very important, and creating vertical pathways for often legal immigrants and people getting their first job and giving them an opportunity to grow their careers over time in the leisure and hospitality industry, we think is a wonderful opportunity that our industry provides. Now, we take very seriously making sure that our employees are legally here, and I don't think there's a broad issue in our industry in that regard, but certainly anything...
Not in the industry, but the knock-on effects.
There is a knock-on effect. We'll see what happens. There's talk and then there's action. Certainly we can't predict exactly what's going to happen. If there were something that resulted in a meaningful pullback in that kind of entry-level labor market, that would certainly have a knock-on effect, as you mentioned, Anne-Marie, in our industry. But what we have shown, that could be inflationary. If there's less available labor, it could be inflationary on wages. If that's the case, we've shown in our industry that we're very resilient. Just looking back to COVID, we were able to manage through a period of rapid inflation and come through that actually healthier than we went into it.
The post-COVID tourism flows have shifted, though, and geopolitics has been an element in that. Russian tourism has disappeared in certain places. The Chinese tourist was very slow to come back into the United States for America as well. What are you noticing with regards to that? Where's the tourism coming from? Where's it going? Where do you want to be? Where do you want to have a property?
Well, I can't give you a specific answer on prospective investments, but what I would say is Indian tourism is way up. China is down. Middle Eastern tourism is up. Russia is down. American tourism to Europe is up. European tourism to the U.S. has come back actually quite robustly. Japanese tourism is down to the U.S. Chinese tourism, or actually all tourism to Japan, is up. Currency flows, macroeconomics all come into play there. We think of those as short-term trends, generally speaking. When you look over the long term, fundamentally, we think that global tourism, global travel flows, if you will, all generally are pointing up and to the right. But yes, everything you said is true. For us, we're looking for those unique destinations that have broad appeal. Ideally, a place that we can take a consumer, if they haven't appealed to the Indian tourist, how do we create more appeal so the Indian tourist that's growing will come to our new destination? Maybe that's in Italy, maybe that's in the U.S., maybe that's in our resorts in the Maldives, just as one example. But I wouldn't say that we're particularly concerned about that. We've never, where the trends are weaker. We've never had a lot of Russian demand, for example, at our properties. But yes, you are right. When we look at markets like Courchevel in France, just as a consumer, the Russian travel to that market is down materially over the last several years.
So I know you can't talk about prospective deals, but you can talk about the type of deals that you are interested in. And you had been focused much more on debt. Now you're much more shifting your focus to equity investments. Why?
Well, I wouldn't say it's a shift. It's more if you look back last year, in a typical year, we deploy about $3 billion of capital, half in debt, half in equity. In the last year, credit debt was up 50% and equity was down 50%. And that was simply a symptom of a big bid-ask gap between buyers and sellers on equity, offset by a tremendous amount of refinancing demand combined with bank pullback on the credit side. Looking forward, we still see those same trends in credit, but on the equity side, we see real reason for optimism. We see NDAs that we've signed increasing. We've seen initial conversations with banks and sellers increasing going into 25. Debt availability is there, so that helps finance acquisitions. Interest rates are down 75 basis points, hopefully more coming. So all of that bodes well for the equity market as we go into the first half of 25. It'll take a quarter or two to play out.
Just before you go, I am an amateur hotel and restaurant critic. Congratulations.
I'm aware, yes.
Il Sereno, Lake Como. Fantastic property.
It is a fantastic
Absolutely
property. I highly recommend it. The self-drive boats there are fantastic.
I did that. The mini Riva boats, a beautiful thing.
They are a wonderful
Amateur restaurant.
Thank you for being one of our past guests.
Anytime, sir. Anytime. Eric, thank you. Good to see you.
Thank you. Great to see you all. Appreciate you having me on.
Eric Resnick there of KSL Capital Partners.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.